There's one account in the U.S. tax code that gets a tax deduction going in, tax-free growth, and tax-free withdrawals. Not two of those, all three. It's called the health savings account, and almost everyone with access to one uses it wrong. In this video, I'll show you how the HSA actually works, why it beats a Roth IRA on pure tax efficiency, and the strategy that turns it into the most powerful retirement account you own. The HSA is the only account with three separate tax breaks stacked on top of each other. First, contributions are tax deductible. If you contribute through payroll, which you should, the money goes in before federal income tax, before state income tax in most states, and before the 7.65% FICA payroll tax. No 401k, no traditional IRA, no Roth IRA avoids FICA. The HSA is the only one. Second, growth is tax-free. Investment gains, dividends, interest, none of it taxed. This is the same benefit a Roth IRA gives you. Inside the HSA, every dollar of growth stays. Third, withdrawals for qualified medical expenses are tax-free, forever, at any age. There's no waiting period, no age requirement, no required minimum distributions. Spend $1 on a qualified medical expense, and that dollar comes out of the HSA with zero tax. After age 65, the rules relax. Non-medical withdrawals are still allowed. They're just taxed as ordinary income, exactly like a traditional IRA. The 20% penalty disappears. So, worst case, in retirement, the HSA degrades into a traditional IRA. Best case, you've saved enough medical receipts to pull money out tax-free for decades. We'll get to that strategy. The IRS rules on HSA eligibility are strict. 5 things determine whether you can contribute. 1. Your health plan. You must be enrolled in a high-deductible health plan, an HDHP. For 2026, that means a minimum annual deductible of $1,700 for self-only coverage, or $3,400 for family. The plan must also cap out-of-pocket expenses at $8,500 for self-only, or $17,000 for family. PPO plans, HMOs, and low-deductible plans don't qualify. If your plan doesn't meet these minimums, you can't contribute regardless of anything else. 2. Your FSA election. This is the most common accidental disqualifier. If you have a general-purpose flexible spending account at work, or your spouse has one at their job, you cannot contribute to an HSA. The only FSA that's compatible is a limited-purpose FSA, which covers only dental and vision. During open enrollment, check the box for the right one. 3. Medicare status. Enrolling in any part of Medicare, Part A, B, C, or D, ends HSA contribution eligibility immediately. Most people enroll in Medicare Part A automatically at 65 when they start Social Security. If you want to keep contributing past 65, you have to delay Social Security and decline Part A. This is a real planning issue for high earners working past 65. 4. Tax dependency. If anyone claims you as a dependent on their tax return, you can't contribute. This rules out most college students and any adult children still on a parent's return. 5. VA benefits. If you've received medical benefits from the VA in the last 3 months, outside of service-connected disability care, you're temporarily disqualified. Veterans with service-connected disabilities have an exception. If this applies, verify with the VA before assuming you're eligible. Let's run the numbers on what the HSA is actually worth. The 2026 contribution limit is $4,400 for self-only coverage, $8,750 for family. Add $1,000 in catch-up if you're 55 or older. We'll model the self-only limit. At a 24% federal bracket, contributing $4,400 through payroll saves you 24% in federal income tax. That's $1,056, plus 7.65% FICA, another $337. Total upfront tax savings, roughly $1,393 per year, just from contributing. No other retirement account avoids FICA. This is the HSA's unique edge. Invest $4,400 per year at 7% for 30 years. Future value, $415,628. That gross number is the same across HSA, traditional 401k, and Roth IRA. Same contribution, same return, same time. HSA scenario, you save medical receipts along the way and use them to withdraw tax-free in retirement. Or you simply pay for actual medical expenses in retirement, which most retirees have plenty of. Net to you, the full $415,628, zero tax. Traditional 401k at the same balance, withdrawn at a 24% retirement bracket. Subtract $99,751 in income tax. Net, $315,877. Roth IRA. Matched pre-tax cost, meaning the same dollars after accounting for the tax you paid going in, gives you $315,876. Essentially identical to the traditional 401k when your in rate equals your out rate, exactly like last week's video showed. The HSA advantage over both, about $100,000 on a self-only contribution. Double that for family coverage. Triple it if you're maxing both spouses' separate HSAs. Six steps to actually capture this. Most people miss steps 3 through 5. Step 1. Confirm your health plan qualifies. Pull your summary of benefits and check the deductible and out-of-pocket maximum against the 2026 thresholds. If you're choosing between plans during open enrollment, the HDHP is almost always the better financial choice if you're healthy and can max the HSA. The lower premiums plus the tax benefits more than offset the higher deductible. Step 2. Max the contribution via payroll deduction. Set it up at the start of the calendar year so it spreads across paychecks. Payroll contributions avoid federal income tax, state income tax in most states, and the 7.65% FICA. If you instead make direct contributions after the fact, you save federal tax, but you lose the FICA discount permanently. Step 3. Invest the balance. Most HSA providers require a minimum cash balance, typically $1,000 to $2,000, before they let you invest. Once you're above that floor, move everything else into low-cost index funds, total market or S&P 500. This is the step almost nobody does. An HSA sitting in cash is just a worse savings account. Step 4. Pay current medical bills out of pocket. Not from the HSA. Use your regular checking account. This is counterintuitive, but it's the key to the entire strategy. You let the HSA compound tax-free for 30 years instead of draining it to pay this month's prescription copay. Step 5. Save every medical receipt. Every doctor visit, every prescription, every dental cleaning, every glasses purchase. Scan them, store them, organize them by year. The IRS has no time limit on HSA reimbursements. A medical expense from 2026 can be reimbursed tax-free from your HSA in 2056. Every saved receipt is a future tax-free withdrawal you've already earned the right to. Step 6. Reimburse yourself in retirement. Decades of accumulated receipts mean decades of tax-free distributions on demand. Need $10,000 for a trip? Pull $10,000 from the HSA, attribute it to a stack of old receipts, and it's tax-free. The HSA effectively becomes a Roth IRA at that point, except you got the tax deduction going in, which a Roth never gave you. 6 mistakes that quietly destroy the triple tax advantage. 1. Leaving the balance in cash, the biggest, most common, most expensive mistake. An HSA sitting in a money market earning 2% is wasting the entire tax-free growth benefit. Move everything above the cash threshold into index funds. This single change is worth tens of thousands of dollars over a career. 2. Enrolling in a general-purpose FSA at work. This is the silent eligibility killer. Most people don't realize a regular FSA disqualifies them from HSA contributions. During open enrollment, decline the FSA. or elect a limited-purpose FSA if your employer offers one. Check your spouse's election too. Their FSA can disqualify you. 3. Signing up for Medicare without planning. Enrolling in Medicare Part A, which most people do automatically at 65 with Social Security, ends HSA eligibility. If you're working past 65 and want to keep contributing, delay Social Security and decline Part A. This requires intent. The default enrollment will end your HSA contributions automatically. 4. Pulling money out for non-medical reasons before 65. Doing this costs you ordinary income tax plus a 20% penalty. The penalty makes it the worst account to raid for non-medical expenses. If you need money, take it from anywhere else first. 5. Living in California or New Jersey and forgetting state tax. These two states don't conform to federal HSA tax treatment. You still get the federal deduction and FICA savings, but your state taxes the contribution and the growth. Real, but smaller than the federal benefit. Don't avoid the HSA because of this, but model it correctly. 6. Defaulting your beneficiary to estate or someone other than your spouse. A spouse beneficiary inherits the HSA tax-free and can continue using it. Any non-spouse beneficiary triggers full taxation of the entire balance as ordinary income in the inheritance year. If you're married, name your spouse. It's the only beneficiary designation that preserves the tax benefit. The HSA is the most tax-efficient retirement account available, but only if you treat it like one. Maximum contribution through payroll, invest the balance, pay medical bills from cash flow, save every receipt. That's the strategy. 4 steps that almost nobody executes, worth roughly $100,000 per career on self-only coverage. Next week, the pro rata rule. Why your backdoor Roth might be partially taxable and you don't know it yet. Subscribe so you don't miss it.